At the very moment, the UK government is rolling out its biggest overhaul of the private rented sector in 40 years. The world has just entered a new and dangerous period of geopolitical instability. When sweeping domestic regulation and a live global conflict collide, UK property investors need to think very carefully about their next move. Welcome back to the Essential Property Podcast. I'm Paul Samuda, and this is episode 70. If you listen to episode 53, you'll know that Amanda and I spent a lot of time unpacking what Donald Trump's return to the White House might mean for UK property markets. Tariffs, dollar strength, inflation, and the risk of a slower global economy. That was a conversation about geopolitical risk at a macro level. Theoretical to a point, strategic positioning for what might come. I have to tell you, things have moved considerably faster than any of us expected. As I record this, it's the 9th of March, 2026, and 9 days ago, on the 28th of February, the United States and Israel launched a coordinated military strike against Iran in what the US has codenamed Operation Epic Fury. Iran's supreme leader has been killed. Iran is retaliating with missile and drone strikes across the Gulf region. Qatar's LNG export facility, the largest in the world, has been targeted. Oil has broken well over $110 a barrel, and there are analysts warning it could reach $150. UK petrol prices are already climbing at the forecourt. And sitting right alongside all of this, just 7 weeks away, is the 1st of May 2026. The date phase 1 of the Renters' Right Act comes into force. Two seismic forces, one global, one domestic, both arriving at the same time. That is what today's episode is all about. So what is happening geopolitically? Let me give you a clear picture of the situation, because I think it's important that we understand what's actually happening rather than reacting to headlines. Iran has been under sustained pressure for years. US and international sanctions, a collapsing currency, internal protests, and significant military weakening following a 12-day conflict with Israel in June 2025. By the start of 2026, Iran's economy was in a serious state. Mass protests had erupted in December and January, and nuclear negotiations between Washington and Tehran broke down definitively in late February. At the end of February, the US and Israel launched coordinated strikes. The opening strikes killed Iran's supreme leader. Iran responded with hundreds of missiles and drones targeting not just Israel, but US military bases and Gulf state infrastructure. Qatar, Bahrain, Saudi Arabia, the UAE, all have drawn into this theater of conflict. Now, why does this matter to the global economy, and specifically to us as UK property investors? 3 words: energy, shipping, and confidence. The Middle East is not just a geographic region, it's the artery through which roughly 20% of the world's oil flows, and a significant share of it is liquefied natural gas, LNG, through the Strait of Hormuz. When that artery is threatened, global energy markets don't just wobble, they spike. And that spike has consequences that travel all the way from a refinery in the Gulf to a landlord deciding whether to refinance a portfolio in Birmingham or Stoke, as we are currently doing at present. Let me just walk you through how this plays out economically in practical terms. First, energy prices. Brent crude has surged more than 25% since the strikes began, from around $70 a barrel to over $110. Qatar's Ras Laffan facility, which produces roughly a fifth of the world's liquid natural gas, has been hit by Iranian drones and declared force majeure on its gas exports. European and UK gas prices have nearly doubled in a matter of days. Analysts at Barclays warn that if the disruption persists another 2 to 3 weeks, Brent could test $120, potentially higher. Second, the bogeyman, inflation. The UK already has gas reserves below 30% capacity. The Economics Observatory has noted this mirrors the vulnerability we saw just before the Russian invasion in Ukraine in 2022. When supply shocks hit, those low reserves amplify price volatility very, very quickly. Chatham House estimates that if oil stayed at or near $100 for the year, UK inflation could be roughly 1% point higher than pre-conflict forecasts. That's not hyperinflation, but is a minimal reverse at exactly the moment the Bank of England was beginning to ease interest rates. Third, interest rates. This is the one that matters most to property investors. The Bank of England has been on a cautious cutting cycle. That is now in serious question. And the New Statesman put it last week, and I'm paraphrasing here, with higher inflation and the government having already spent heavily on previous energy crises, the bank is unlikely to feel comfortable cutting rates further. Borrowing costs that many investors had been expecting to fall may instead hold or remain elevated for longer than projected. The market is suggesting a 0.25% rise or a 0.5% rise if this war carries on for a long period of time. Fourth, currency and financial markets. Sterling has come under pressure. Equity markets have sold off. These are the classic risk-off signals. Investors move to safety, reducing exposure to uncertainty. And when financial markets get nervous, the ripple effect travel into property finance, development lending, and investor appetite. Fifth, supply chains and construction costs. Shipping costs have surged, port movements across the Gulf have slowed, and freight insurance premiums have spiked. The material used in property refurbishment, many of which have components sourced or transported through the affected regions, are going to face an upward cost pressure. This isn't immediate, but it is real. For anyone pricing a refurbishment job or a conversion project right now, that uncertainty needs to be built into your contingency. So what does this mean for the UK property market? Let's bring this home quite literally. Mortgage rates. We've been watching the trajectory of base rate reductions, and many investors have been underwriting deals on the assumption that rates continue to fall through 2026. The assumption is now massively in doubt. 2-year and 5-year fixed rates could stay stickier than expected. If you're refinancing, extending, or raising development finance in the next 6 to 12 months, your cost of capital may not look the way you plan. Stress test accordingly. Let's look at development finance. The same logic applies. Bridging lenders, development finance providers, they price risk. When macro uncertainty rises, risk premiums rise with it. Facilities that looked comfortably viable 6 weeks ago may now need to be renegotiated. Timescales matter more because time is now more expensive. Investor confidence. Broadly, this kind of global event creates a pause. Investors sit on their hands. Deals that were in the pipeline just slow down. Some exit the market entirely. For those of us with quality stock in strong location, that's not necessarily bad news, but it does mean that the market will move differently over the next 6 to 12 months. Rental demand. Here is something important to understand. When investor confidence falls, supply shrinks. When supply shrinks, rental demand tightens. We already have a structural housing shortage in the UK, as you all know, that no government has come close to solving. Geopolitical shock does not solve that. It usually makes it worse. For landlords with well-managed, compliant, quality stock, strengthened demand is a likely outcome of this of this uncertainty. Rents in many markets will continue to be supported. For HMO operators, this is particularly relevant. The HMO model serves exactly the tenant profile that struggles most in times of economic stress. Working professionals on modest incomes, young workers, people relocating for employment. Demand for that type of accommodation does not fall when times get hard. It rises. If you're running a well-managed HMO in Stoke, Birmingham, Burton, or Warrington, or any of our key markets, your fundamentals remain sound. For service accommodation operators, the picture is a little bit more nuanced. Business travel demand can soften in periods of economic uncertainty, but leisure demand is more resilient than many assume. And in hybrid models, flexibility becomes your advantage. So what about the Renters' Rights Act? How does that compare with the conflict we're seeing abroad? Let me give you the headline analysis because I think this is the most important moment in today's episode. The Renters' Rights Act was already creating pressure for landlords before a single shot was fired. Now, with global conflict pushing energy costs higher, threatening interest rate cuts, creating economic uncertainty, we have a convergence of domestic regulation and international economics that will reshape the landlord landscape for years to come, maybe. Phase one of the Renters' Rights kicks off in May, 1st of May. Section 21, no fault eviction is abolished. All assured short hold tenancies automatically convert to rolling periodic tenancies. Landlords can raise rents once a year via formal Section 13 notice. New possession grounds require specific legal reasons. 1 month's rent up front, maximum. Civil penalties of up to £40,000 for serious or repeated breaches. This is the most significant overhaul of the private rented sector since the Housing Act in 1988, and that is no exaggeration. Now, here's what the combination of Renters' Rights Act and global conflict actually means in practice. Some landlords will leave the market. I've had 2 emails today saying, Paul, is it time for us to sell? Those with smaller portfolios, those who are over-leveraged, those who have been operating informally, those who find compliance too burdensome, some of those will sell up. That supply leaving the market and reducing the supply, as we've discussed, tightens rental demand for those who remain. Development activity will slow when finance costs are uncertain, when construction costs are volatile, and when new regulations add compliance burden. The incentive to start a new project weakens. That's more suppression of supply. Again, that ultimately supports demand for existing rental stock. And here is something I want to say clearly. The biggest risk in any period of uncertainty is not the event itself, it's the reaction to the event. Investors who panic, who sell quality assets at the wrong moment, who stop investing entirely and sit on cash, they tend to look back in 3 to 5 years and regret those decisions. Investors who remain calm, think strategically, and position themselves well during periods of uncertainty are typically the ones who benefit most when clarity returns. So what about the guidance for investors who are funding projects? Let me give you some practical strategic thinking for the next 6 to 12 months. Maintain liquidity. This is not the moment to be fully deployed with no cash reserves. If you're raising capital for a project, build in additional contingency, not just for the construction cost, but for the time. Projects that overrun in a high rate environment become expensive very quickly. Stress test your deals at current rates, not at projected lower rates. If a deal works at today's mortgage rate, it's more resilient. If it only works on the assumption of 2 more bank base rate cuts this year, then think again. Avoid over leverage. I know that feels like obvious advice, but I've spoken to too many investors recently who are planning aggressive refinancing strategies on the back of optimistic rate projections. In volatile macro environments, the quality of your balance sheet matters as much as the quality of your portfolio. Watch our friends at the Bank of England carefully over the next 3 to 6 months. The MPC meetings will be more significant than usual. The direction they take will tell you a lot about the trajectory of borrowing costs. Structure finance carefully for HMO projects, conversion projects, or refurbishments. Talk to your lenders now, not later. Understand how they're pricing risk in the current environment. Build relationships. Know your exit routes before you go in. Focus on quality assets in strong locations. This is a consistent principle across every economic cycle I've observed. Well-located, professionally managed, compliant properties in markets with structural rental demand are the most resilient investments in uncertain times. Mid-market HMOs in strong employment areas. well-converted service accommodation in locations with both business and leisure demand. These are the assets that weather cycles best. Let's have a look at the strategic perspective for landlords. I want to zoom out for a moment because perspective really does matter. In 1990, the UK was in a recession and interest rates peaked at 15%. Not wanting to reveal my age, but I remember that clearly. Property values fell. Many investors lost confidence. The ones who held on or who bought carefully in that period built exceptional wealth through the 90s. In 2008, the global financial market collapsed. Credit dried up, development stalled. Investors who maintained quality stock and navigated the financial environment carefully went on to benefit from one of the longest periods of rental demand growth the UK has ever seen. In 2022, energy prices spiked following Russia's invasion of Ukraine. Inflation hit 11%. The UK market wobbled, and yet by 2024-25, rental demand was at record levels across the key markets. Geopolitical shocks are not new. They're uncomfortable, they are real, and they demand a thoughtful response. But they do not override the fundamental truth of UK housing. We do not build enough homes. We have not built enough homes for decades, and regulation is making it harder, not easier, for new supply to come forward. For professional, well-capitalized, compliance-ready landlords and investors, that structural imbalance is a long-term foundation for the asset class. And certain periods like this one are not the moment to panic. They are the moment to think clearly. So if I were to give a closing summary, it will go something like, geopolitics matters more than most property investors realize. We mentioned this back in episode 53. It was a new spin for us as podcasters to talk about international politics. Regulation and global economics are converging, and the next few years will reward thoughtful, well-capitalized investors who keep their nerve, manage their risk, and stay focused on the long game. My favorite phrase is keep the eye on the prize. Let me leave you with this. We are 7 weeks from the most significant regulatory challenge in the UK private rented sector since 1988. At the same time, we are 9 days into active military conflict in the Middle East that is pushing energy prices to levels not seen since 2022, threatening to delay Bank of England rate cuts and create genuine economic uncertainty across global markets. That is a lot to process. I get that. But let me be very, very clear about what I see in this moment. Landlords who are well managed, compliant, and properly funded are not the ones who need to be worried the most. The ones who need to worry are those who were already stretched, over-leveraged, under-compliant, and poorly positioned. For them, the combination of renters' rights and macro headwinds will be very difficult. For those of you who have been building portfolios with quality managed properties professionally and thinking about the long term, you're about to see some of your less prepared competitors exit the market. That creates opportunity, not immediately, but it's coming. Stay informed, stress test your positions, maintain your liquidity, know your numbers, and whatever you do, not make decisions based on fear. As ever, if you want to talk through what this means for your specific portfolio or project, you know where to find us. I'm Paul Samuda. Thank you for listening to the Essential Property Podcast. Take care of yourselves, take care of your tenants, and I'll see you in the next episode.